Welcome to The Explainer. Today, we're going to tackle a financial tool you've probably heard about, but maybe don't fully get, the reverse mortgage. So is it a golden ticket for retirement, or is there a catch? Let's find out.
So here's our game plan. First, we'll talk about why someone would even consider this, that retirement cash crunch. Then, we'll break down what a reverse mortgage actually is. We'll weigh the pros against the cons, figure out who's a good candidate, and wrap it all up with the big takeaway.
All right, let's dive right in with the core problem. I mean, this is a situation that so many people find themselves in, and it's pretty much the whole reason reverse mortgages were created in the first place.
Have you ever heard that phrase, house rich, cash poor? Does that ring a bell? It's this classic dilemma, right? You've spent decades paying down your mortgage, building up all this value in your home, but when an unexpected bill pops up, you can't exactly pay for it with a piece of the living room.
So let's make this real. Imagine someone named Margaret. Her home is her biggest asset by far, but that asset isn't liquid. It's tied up in bricks and mortar. She can't use it to pay for that surprise car repair or a medical bill. It's a really stressful spot to be in, and honestly, it's way more common than you might think.
So what is this thing that Margaret keeps hearing about in those late-night TV commercials? How can it possibly turn her house into cash without forcing her to pack up and move? Let's get into it.
Okay, in the simplest terms, it's a loan that works completely backwards. Instead of you sending a check to the bank every month, the bank sends money to you. You can get it all at once, as a monthly payout, or as a line of credit you can tap into. And here's the kicker. The loan only has to be paid back when you sell the house or permanently move out.
This really just flips the entire concept of a mortgage on its head. Think about it. With a regular loan, every single payment you make builds your ownership, your equity. But here, it's the total opposite. Every payment you receive from the bank increases your debt and slowly chips away at your equity. That right there, that is the fundamental trade-off.
Now, it's really important to know that most of these loans are a specific type called a HECM, which is insured by the federal government. And that is a huge deal. It provides this critical safety net that guarantees that you or your kids will never owe more than the home's actual market value, even if the housing market tanks. It basically protects you from ever being underwater.
Okay, so let's talk about the good stuff. Why would anyone do this? Well, for someone in Margaret's shoes, the benefits can be an absolute lifeline.
So what's the big appeal? Well, for starters, you get cash flow, which can immediately relieve that financial pressure. You also get all this flexibility in how you receive the money. But you know, for most people, the biggest win is this. You stop making monthly mortgage payments, and you get to stay in the home you love. It's the key to what experts call aging in place.
But this is the point where we absolutely have to pump the brakes. A reverse mortgage is not free money. It is a loan, a very complex one, and it comes with some serious costs and risks that you have to understand completely.
Let's just start with the upfront costs, because they're not small. On a $350,000 home, just like Margaret's, that FHA mortgage insurance premium alone could be a whopping $7,000. And that's before you even get to origination fees and other closing costs. It's a significant chunk of money taken right off the top.
And here it is again, that core trade-off. While you're enjoying not having a mortgage payment, that loan balance is quietly growing in the background. See, interest and fees are being added to the loan every single month. This means your debt goes up while your home equity goes down. It's almost like your house is slowly buying itself back from you.
And you have to remember this. Your responsibilities as a homeowner do not disappear. You still have to pay the property taxes. You still have to pay for homeowner's insurance and handle all the upkeep. If you fall behind on those payments, the lender can actually foreclose. And of course, this is a decision that has a huge impact on your heirs. It can seriously reduce or sometimes even completely wipe out their inheritance.
So, with all those serious risks in mind, it's pretty clear this isn't for everyone. And that's exactly why the eligibility requirements are so strict. Let's take a look at who might actually be a good candidate for one of these.
Okay, there are basically 3 big hurdles you have to clear. First, your age. You've got to be at least 62. Second is equity. You need to own a big chunk of your home, usually over half of it. And finally, financial stability. The lender is going to do a deep dive to make sure you can really afford those ongoing costs we just talked about, the taxes, the insurance. They want to know you can afford to stay in the home for the long haul.
Now, this next step is completely non-negotiable. Before you can even get one of these loans, you are required by law to meet with an independent, government-approved counselor. This is not a sales pitch. It's a critical safeguard designed to make absolutely sure you understand every single detail of what you are signing up for. So before you even think about making any calls, you need to have a really serious talk with yourself and with your family.
I mean, if you think you might move in just a few years, those huge upfront costs probably don't make sense. And being brutally honest about whether you can afford the ongoing costs for the rest of your life is absolutely essential.
Okay, let's tie this all together. What's the final verdict here? And what should you be looking at if a reverse mortgage just doesn't feel right for you?
You have to remember, this is not your only option, not by a long shot. A home equity loan or a HELOC might have much lower fees, but you'll have monthly payments. Downsizing to a smaller place could free up a ton of cash with no new debt at all. And it's always worth looking into government assistance programs or even just having an open conversation about support from family.
You know, this quote from our source material really just says it all perfectly. For the right person in the right situation, someone like Margaret who wants to stay in her home above all else, it can be a really effective tool. But it is not a magic bullet that solves every financial problem.
And that really leaves us with the ultimate question, doesn't it? Is tapping into your home's equity the key to securing your own future, or is it an unacceptable risk to your legacy? There is no easy answer. It's a deeply personal decision that all comes down to careful planning, open conversations, and a very clear understanding of what matters most to you.